As we discussed on an episode last September, there are two main ways a company can return money to shareholders. The first is a dividend. A share of the company's profits are distributed to shareholders on a regular basis, usually every quarter. And the second is a share buyback. That's when a company buys its own outstanding shares, which reduces the supply of shares on the open market and thus increases the share price. Now, historically, dividends have been more popular, but recently that started to change. Over the past decade, share buybacks among the world's 1,200 largest companies tripled, and last year, share buybacks hit a record of $1.3 trillion. That's almost the same amount companies paid in dividends last year. Meanwhile, over the past 10 years, dividend payments have only increased 54%. So, Scott, the obvious question here is, why are companies choosing share buybacks over dividends? But before we get to that, can you refresh our memory on why a company would buy back shares or pay dividends in the first place?
So a dividend payer, there are a lot of investors who are willing to put $100 into a stock and then wait till they sell it, hopefully, hoping to get some appreciation. There are other investors, usually a little bit older, that want dividends, that want cash flow. I'm like, okay, I've got $100,000 and I want to get $4,000 a year. I want to get some type of cash flow. I need some money to live. They like dividends. One of the reasons that stock buybacks have been so popular is that, essentially a stock buyback is the following. You have $100 in earnings. You have 10 shares. That's $10 per share in earnings. If you buy back 20% of your shares, you have 8 shares, it's $100 in earnings. Now you have $12.50 per share in earnings, and the stock should go up. And what that does is, for the shareholder, you get taxed on dividends. But effectively, if you're not selling your shares, it's a way of increasing or distributing capital back to the shareholder, at least capital appreciation, without an immediate tax hit. Now, sometimes they do a hybrid of that as a one-time dividend. But also, it appears the market, at least in the short term, likes these share buybacks, and it's a means of a CEO who makes most of these decisions with his or her CFO of moving the stock up in kind of the medium term, between 1 and 4 years, the vesting period of the CEO, so he or she can get their Gulfstream in their home in the Hamptons. So the controversy is whether or not there's so much money going into share buybacks. I think I read that Apple has bought back $600 billion worth of shares, which means that if Apple had decided to try and grow through acquisitions, it could have bought any but maybe the 3 or 4 most valuable companies in the world with that money. But instead it buys back shares. The fear is that rather than growing the economy, rather than investing in new plants, property and equipment, new hiring, you're just trying to push up the share price, which largely benefits a small group of people. I think about 90% of all shareholder equity is owned by the top 1%. And the question is, well, okay, do we have sort of a perverse incentives here where share buybacks are great in the short run for the CEO, but maybe not for the economy? So there's been additional taxation placed on share buybacks. They're talking about increasing it. But it is a very efficient way to return capital, if you will, to shareholders.
But it would be the same. It's in effect the same thing when you refer to expanding the real economy as opposed to pleasing your shareholders. Buybacks and dividends, it's effectively the same thing, right? You're just investing in returns to shareholders. You're not investing in the real assets of the business.
Well, you're giving money back to investors who then can decide what to do with that capital, as opposed to having, the question is, if you're on a board, the question you should be putting forward to the CEO is, you don't have any new ideas. You don't have any ideas on how to grow this company. We're making money and you don't have ideas about how to reinvest. That you can't come up with any ideas on how to reinvest this money that'll get us a greater return than the S&P. And oftentimes the answer is no. We're a mature company and we are going to buy down shares. Also, just as a function of normal business, there will be additional shares issued for new management options. So some share buybacks just keep the number of outstanding shares at parity. But there's real concern that it's just gone way overboard, that the CEO's go-to is to buy back shares because it's sort of the most reliable way for a profitable company to move the share price up. And again, it all comes back to the same place.
Yep.
Behavior is driven by compensation. And that is, decisions aren't made on what's best for the company. Decisions aren't made on what's best for the Commonwealth. Decisions aren't made on what is best for the employees. Decisions are made on what will move the stock price up in the medium term. In the next 1 to 4 years, when the CEO and the board vest their shares, right? And so most decisions are made around what will move the stock price up between now and the next 48 months, full stop.
Yeah. 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 There's also some arguments against, which found interesting. One is that, kind of like you say, there's this self-serving bias for the company's executives, but there's a very specific bias here, which is that if you take shares off of the market, you essentially inflate the earnings per share because the profits are being divided up among less outstanding shares. And typically executives get bonuses that are tied to increases in earnings per share. That's been one of the big criticisms, but something that I was thinking in pushback to that criticism, isn't it on the board and the shareholders to create the right incentive structures for the CEO? In other words, shouldn't they be the ones that are taking buybacks and any manipulation that you could do to earnings per share and any bonuses that you get as a result of that? Isn't it on the board to figure out how to accurately compensate the CEO such that they incentivize what's best for the company?
Well, 100%. But how does the board get compensated? They get some cash and they get options. So they too are incentivized around the same thing. The question around the CEO is, how do you ensure that you have the right metrics linking to their additional options grants? And do you do RSUs? Do you do options? How much do you pay them? But, and I've always thought compensation is the hardest part about being on a board, because you try to figure out a way, whenever you see really strange behavior at a company, you can usually reverse engineer it to compensation. So, for example, in the early days of the internet, it made sense to gather email addresses. Email was the most effective digital marketing tool, that if someone walked into a Coach store, if you got their email address and they bought something, you could send them additional offers for similar products, really high conversion. But here's the thing. The store managers weren't compensated based on e-commerce sales. So what was their incentive to try and get email addresses? Meanwhile, the head of e-commerce at Coach was not really that interested in driving traffic into the stores, because guess what? Her compensation was not based on in-store sales. So linking compensation to behavior is incredibly difficult. But what you have with boards, they approve share buybacks because at the end of the day, the board's not going to come up with a vision for the company. That's just not their job. They might advise the CEO and have some ideas, but it's really management's, the CEO's kind of vision for the company, because he or she is the one that actually has to make it happen. And if you're a company, a mature company, and you think your stock has been unfairly punished and you're making a lot of money, it makes sense probably to buy back some shares. It reflects confidence. What's really interesting is companies like Restoration Hardware have actually taken out debt. They've actually borrowed money and bought back shares, which is a really interesting play.
And you seem really irresponsible. I mean, I don't have any basis in that. It just feels irresponsible.
It's aggressive, but you could make an argument if you feel your stock is deeply undervalued, you can access the debt markets at incredibly low interest rates, which you could, 2-3 years ago. If you could borrow money at 2 or 3%, you might say, the CEO might go, you know what? I'm going to be able to grow this company faster than 2 or 3% a year. So it is, it can go very wrong very fast. And generally, I think you're right, Ed. I think your gag reflex is probably the reflex that it kind of indicates, as usually a CEO kind of controls the board. But share buybacks,
it's like desperate in a way. It's like you're borrowing money just to inspire confidence versus invest in real assets. It feels like.
I think that's an interesting and valid take. But what you're probably going to see, you might see an increase in the tax on share buybacks, because it does look as if we've entered into this kind of circular mechanism for creating more income inequality. The existing shareholders got wealthier, but the engine of capitalism, corporations, aren't investing back in "quote unquote" the real economy. They're not buying more land. They're not putting up a new factory. They're not making new hires, because they're like, at the end of the day, let's just buy back shares.
I just want to end with a case for share buybacks versus dividends, which is that the historical advantage of dividends is that you can earn some cash without having to sell the stock. And in the past, selling stock was kind of a pain. There were trading fees. The fees were especially high when you were selling less than 100 shares at a time. But now that we have all these trading platforms that have zero commission trading, and they even allow fractional share trading, it's not really a problem to sell anymore. So you can take, what's called synthetic dividends, where basically you just sell your stock in increments and you get to choose when to sell. As you said, you can also defer your tax payments. So it feels like share buybacks might be a marginally better deal if you're paying attention to the stock. And if you're paying attention to when to sell and if you want to actively be selling your stock. Would you agree that that's a fair case?
Yeah. And it's definitely, I think that's accurate. And historically, it's been a mix in terms of returns to investors. It's been a mix of capital appreciation or appreciation of the stock and dividends. Yeah. I also wonder if it's just a psychological, it just seems like dividends feel boring in this age of crypto and stocks going up 50% sometimes in a year, that investors are just a little hornier and not as excited. They don't want to marry a nice guy, right? They want something fun. They want something, I want to get rich. And a dividend, it just feels like, okay, I'm going to, turn on Murder, She Wrote, put some kaopectate on my hemorrhoids and collect my dividend checks. It just feels old. It feels, I don't know, it feels very 1970s for some reason. I don't know where I got the kaopectate, but anyways.
I think that's probably completely accurate. There are so many weird technical details over something that doesn't appear to really matter. And yeah, I'll bet you're right. It's just a vibe shift in what feels sexier as a management executive.
Do you own any dividend-paying stocks?
No, I don't.
It sort of outs the company as no longer growing a little bit.
Yeah, it reminds me of Nike, which does pay a dividend, but one of the first things that you see on their investor relations page is Nike is a growth company. It's like the main message they're trying to get across to investors is we are future forward. Yeah, we pay dividend. We may look old, but we're looking at the future.